In this video, we're talking about why your emergency fund is keeping you broke. Contrary to what Dave Ramsey and your parents might tell you, if you have been working hard and you're finding that you're not getting ahead, there's a good chance that it's because you have an emergency fund. This is just wasted opportunity. This took me a long time to figure out and has been one of my biggest mindset shifts. I and most of my successful investor friends have all come to this realization. Once you understand that an emergency fund is just lazy money that doesn't have a job, everything changes. I'm sure you're wondering, how would you handle an emergency? Well, I do have some real life examples on how I have handled this, and then I deep dive into how you can do the same. Let's dive in. So, my name's Mike, and in 2022, I had started with just about $20,000 cash, and then I had actually borrowed from my paid off car to get into stocks when they were at a discount. And then I borrowed against margin to buy more shares to blow up my portfolio to about $100,000 early on in the bear market. And then at the time the bear market had ended, I had some exponential gains. I actually repeated this during the tariffs in 2024, and that's how I created the system that I use today. So I actually have a sheet that I track all of my stock net worth and my income and expenses from it that I started doing when I realized that sometimes some big emergencies do come up and that it can be pretty impactful and it can have a negative feeling at the time. But what I mean by this is back in 2024, I was kind of peaked out here. Let's go to a different screen here so you can see this is what I own minus the debt. So I was at about 260 and then it went all the way down to about 206. So it went down by like 55K in like 2 weeks. Well, why did this happen? Well, one, the market just went down around this time, and two, I also had an emergency come up. That emergency, quick little story for you, was in 2022, or it was 2024. I had a rental property where a tenant just moved out, and they were letting their dog poop and pee in every single room, and most of the house was carpet. So I had to replace all of the carpet, all of the pad underneath it with vinyl plank flooring, but that's not it. In addition to that, there was water in the basement, and I had a bowing wall, which is where the wall is starting to cave in. So I had to stop that from happening so the foundation doesn't get ruined. I had to put drain tile in the basement to stop the bowing wall. Why it happens is because like water builds up when it rains, and say the wall is here and water builds up, and it just creates a lot of pressure. So they put some tile around the bottom to allow the water to feed into a sump pump, and then that gets pushed out of the house. So that relieves a lot of the pressure. So I had to install that. Plus, I had to install some anchors to like stop the wall from like collapsing in the middle. And between that, the flooring and the drain tile, all of it cost me around like $25,000. I think I actually did the drain tile at a later date, and that was like an extra $8,000. So that was super annoying. But what I do here is I track my margin net worth, which is my total value minus my debt. And then I have all of the dates, as you can see, and they're all lined up. And I have this black bar down the middle that separates them out. And then I show how much my bill costs each month. And then I show how much I get paid in dividends for the stocks that I owe at certain times. And I didn't start doing this until like halfway through, so about 2024. And then I track my all time dividends just out of curiosity. And then I track my interest rate. And I didn't start doing this until, again, probably like right here. But when I started, my interest rate was 2%, which is pretty much like free money. So I can see why, I'm sure you can see why I started doing this. Actually, what made the mindset shift for me was I saw a TikTok from Damon from Shark Tank who talked about how rich people, they never sell and they borrow against their assets to buy more assets. I actually made a full video deep dive into this strategy. You can see what I started out with in terms of net worth versus total value, and you can see how quickly I had jumped up there. But then every single, like basically every couple days, the market was down. So this stayed pretty steady, and then this stayed pretty steady. Actually, yeah. So this had stayed pretty steady for most of it, but I was just dumping all my cash in like all of the time. And then quickly at around the end of 2022 is when it started to just skyrocket back up. And you could see that in the chart that I had before, and you can see it in practice here too. And then it went all the way up for most of 2024 until I had mentioned I started putting notes because I was like, okay, well, sometimes I have to spend like 20,000 or I might make like a lot at once because of real estate commissions. So I started adding notes so you can see why there's big differences between the two. And I only track on the last day of the month for this screen. And then I do have other screens that I'll go over in some future videos. But since it's not the point of today's video, I won't go too deep into it. But this, maybe we'll talk about this in like a budgeting video or like tracking your net worth, because this is like my entire net worth here, just to give you a quick idea. And it's getting close to 800, but it's temporarily down a little bit just because the market's down a little, but let's go back to where we are. And I track all sorts of stuff you can see on the bottom here. So here I had moved over some money from my 401k to M1, and here I had sold a house and I moved the equity to M1, and then I borrowed back to buy my next house. And the 401k thing, I guess the reason I did that was because I don't want to wait until I'm 70 to use my money. Well, really, it's like 60, right? And 59 and a half, yada, yada. But I do have some money in my 401k, just to be transparent with you guys, as always. I do think that this is more powerful. The reason is because one, my money was in something more comparable to the S&P, and I only paid like 4,000 some dollars in taxes and in the 10% penalty. And then I mathed out, and it would take me maybe at like a 15% return instead of like a 10% return or whatever. And those are just rough numbers. It would have taken me something like 8 years or 9 years to make it worth the switch. So I was like, okay, well, I'm just going to make the switch. And I did. So here you can see what had happened like over time. So during the tariffs, you can see that there was kind of a little dump down there, but since just all my incoming money was going in, it wasn't as like steep as it maybe was in the actual graph of my biggest anchor, which is VGT. And then when it went up, you can see that I greatly benefited from that because in just like 4 months, from maybe even 3 months, from maybe February until like April, I had borrowed about 100,000 to go ahead and add in. So to show you quick what that might look like, let's see, where's my debt here? That'd be this screen. So I went to here, we'll go to like here, and then it went up, and then it went up, and it went up, and it went up. And sometimes I was having like ten or $15,000 buys in single days. Like, this is the power of using this strategy. And I do outline the full strategy in my blueprint. So it's titled Money Isn't Real, and it's in my description. So just to let you know how that works. So just to touch a little bit more on how you can use an emergency fund, or how you don't need an emergency fund, but you can be safe without one. I'm gonna go back here, and that's not the right screen. So let's see here. So this would be my margin. So you need to keep your margin health at a safe percentage. So just to let you know, none of this is financial advice. This is just educational and entertainment. And I'm not a financial advisor. This is just what I do. And you're going to want to make sure, if you want the full strategy, to either check out my blueprint or to make sure that you watch all of my other videos in full so you don't miss some key details. I outline a big, kind of a nice overview for you in all of my videos. So I always keep my margin health. I try to keep it above 70% in a healthy market. But if there was an emergency, I could borrow, like, say I needed $30,000. That's should cover most emergencies, I would hope. Like, say my truck, something happened and I needed a new truck. This would give me a payment of $135. I wouldn't have to go to the bank to get the loan. This is a variable interest rate, so it can go up or down. But right now we're headed in a downward direction, meaning that the Fed is about to cut rates on next Wednesday here, what is that, like the 29th? And then my payment would be even smaller. So if you only needed like a $10,000 emergency, probably don't need $10. But if you needed $10,000, that only cost you 45. This is actually how I bought my sauna, which was like $8,000. So it gave me such a small payment. So it can, like, as you get bigger, this can allow you to do some pretty cool things. And And then the important thing, so people ask me a lot. I actually answered a comment on this morning is like, since you don't focus on dividends and you focus on growth, how do you pay for your debt? Well, on the other screen, you can see that my dividends pay for about a third of my debt payment. So, like right here, this is about a third, like every 3 months now it's around that. So, it's like a third of it. But then I have income that I use to pay for that. So, you might watch a lot of people that do covered calls, maybe don't. Maybe you watch like people that income invest with their margins so that they can have it cover most of their margin payment. I don't do that. I think growth is better, and I'm here to show you the results of that over time. This is since 2022. This is just since last year. When you do income instead of this, you don't see graphs like this. And like this includes the tariff dip of 2024. Yeah, you just don't see graphs like this when you do growth. And same, let's go. I'm looking for this screen here. Let's look at the 1 year. Like this is through the tariffs, and this is like this is when I bought my truck. So that's why it declined so fast. And then I had some maybe some incoming money, but like this is the way, in my opinion, to do things. So just to briefly give you an idea of how to be safe, you do want an anchor. Some other anchors would be, so mine is VGT. Some other anchors, I also use VU as like a small anchor. It's about 10% of my portfolio. You can see this is 72%. And then there's a lot of people that might use something like VUG, SCHG, maybe VOO is their biggest anchor. In my opinion, that's kind of a weaker anchor. It's a little safer, but its performance is closely tied to the like I don't know, you might get like a 10-12% return versus your margins like 6% ish, so you don't have as big of a spread, so it's not as powerful. So essentially, if you ever have an emergency, you can borrow from your margin, and you can also borrow from like a paid off vehicle. If you needed to, you can put your money on a credit card and you're good for 30 days. Make sure that you always pay off your credit cards in full. Make sure you're never leaving anything on there because your interest rate is like 20% and you're not gonna out return that often. Like you might for short periods of time, but it's just not wise to have credit card debt and be walking around with that. There's just different lines of credit you can take. So another line of credit would be if you have enough equity in your house, 20% or more, you could take out a HELOC where you don't have to refinance and you get to have essentially a revolving line of credit, just like your margin. What's great about your margin is that as I pay back more margin, I free up more margin to be available, meaning that if I pay 5,000, I have the access of touching that 5,000 again if I need it. This is easy to do when you have a small portfolio, but as you grow bigger and bigger, you have to be careful because it gets harder to pay back large balances. So me and my friend Margin Mindset were talking about how when we get into the millions of dollars, this might change a little how we do things just because it's easy to pay back like 30, $40,000 of margin, but it's not so easy to pay back. We're already noticing, say, like 200,000 takes a little longer versus when you're in the millions and you're paying back like 500,000 and like things like that, that's going to take a little longer. It's like we're not high income earners earning $500,000 a year. So up up until this year, I've never earned over 100,000. Now I'm making over 100, so it is a little easier for me now. I have some more gems coming up for you guys here, so make sure you check out some of my other videos. See you guys next time.